Hello, welcome to the Risk Wranglers Traders Workshop. In this episode, the derivative desperados will unravel why a flurry of 110 lot option trades can jolt the implied volatility surface more than a single massive 1,000 lot block trade. Let's break down the mechanics of how these two 1,000 lot trades are very, very different after the bell. Wow, Mark.
So it's derivative desperados? I thought we were risk wranglers.
We're both. I use risk wranglers. I throw derivative desperados in there. It's kind of a little mixed bag right now. You're going to be the trucker hat cowboy. I will have the cowboy hat cowboy. I get it. Jason, we're not sure where you're going to fall yet. We're not exactly.
I'm not a cowboy.
I'm a cowboy.
I had a hat. I have a hat.
Yeah. Good morning, gents. Welcome. How you been?
I'm all right. How are you?
Good. I would say if I were back on the floors as a market maker, I'd be enjoying the living daylights out of this market. Not to mention my pockets would be stuffed
surfing
with
the chop.
Yeah. I talked to a good friend of ours, Mark, the other day. I won't give any names. But you know who I'm talking about, another wine drinker. And I said, I'm sure you're loving this volatility. He goes, I'm not saying anything, but I got a smile on my face. So, yeah. Mark knows who I'm talking about.
Wine prices are about to go up.
Yeah, exactly. Oh, he's Mark's on tape delay. Uh-oh. We got tape delay, Mark. All right, let's get to it. So,
too bad.
Mark, I'm going to let you lay this up a little bit. You wrote in your blog, The Till, harvestedfinancial.com, about how a 110 lot trades can be very, very different than a single 1,000 lot trade. 100 times 10 is 1,000, same 1,000 as one big mama. So, Jason, you may feel differently about this. Mark and I are going to come at it from the perspective of making price and making curve and making liquidity, and how that's very different for someone like, us in our past lives and how it hits the market maker community. You want to lay it up, Mark, or any more?
Yeah, for sure. No, I think this came out of a comment that maybe I made last show, and like someone wanted to double click on it because at face value, the arithmetic is the same, right? 110 lots is going to be the same P&L as 1,000 lot. It's going to have the same Vega. It's going to, as far as all the data and, arithmetic of that trade, they're identical. But I think the difference really comes down to, and this is like one of those art and science things about trading, that it's the information content of 110 lots is vastly different than the information content in 1,000 lot. And really the price of volatility, when you're trading volatility, you're as much trading the information that is coming in about the future expectations of that volatility. So,
right.
In that space, these two are vastly different.
Right. So, I would tell you that we definitely dealt with that as DPMs on the floor back in the day. Right. And from my perspective, I think the annoyance of the 110 lots is that, for at least for us, is we don't know when it's going to end. At 22 trades or 25 10 lots, I'm like, okay, is that the end, or do we have 75 more to go? Right. So at least with the big piece of elephant dung in 1,000 lot, I know where the dung is going to fall. Right. And I can take it down at probably a pretty good price. If I'm going to do 1,000, I'm going to have a very good price. And then the curve may get pushed out of line a little bit at first, but it's going to settle much quicker, I think.
Totally agreed. Because like you say, you price that order, you focus on just that one big, trade, and then you reset and the market has time to digest that. I think what happens a lot with 110 lots is they're coming in rapid fire. There's not time for the market to reprice and adjust to what's happened, trade other options against it, shift the curve. You're just getting lifted on skew and need to get out of the way as fast as possible. So because of that, like temporal aspect of price discovery, if it happens too fast, it's indigestion for the market.
Right. For sure. Jason, any thoughts on this? I know it's not really your wheelhouse with the market.
Well, no, I mean, I've never worked as a DPM like you guys have. So from my perspective, when I'm executing on like a retail level, I find that I'm getting better prices if I do 110 lots as opposed to 1,000 lot, right? Or it's like an easier execution, or not easier, but a better priced execution. Like I'm closer to the mid, the smaller my order is. And the one question I would have is, even though the 110 lots, you see them coming in and it keeps going and going, how do you know the 1,000 lot is the last one?
Well, that's a good point, I suppose. But I think the 1,000 lot. So take it this way. Look at it slightly different, right? I was in the SPX last week, right, down in the pit, doing a show. Okay. What I learned is that 0 DTE trading is exclusively done on the screen. Every 1, 2, 3, 5 lot, which most of the 0 DTE is conducted electronically. Any other order that has some time maturity to it, and the longer dated it is, the more it becomes open outcry in that pit, because they're trying to get a single price discovery on a large order so that they can put it up, right? Okay. So that's what happens. And then and the reason I say that is because what I'm going to do as a trader in a verbal environment, non-electronic, is I'm going to look the broker in the face and say, how many more are coming? Is this it? Do I need to prepare for another onslaught of 1,000 lot or not? I can do that in open outcry. I cannot do it electronically. So you're right. There is an element of, if this 1,000 lot shows up electronically, I might not have full information on what's behind it. I totally could see that as being an issue. Mark,
and the broker knows what's coming behind it.
Certainly, the broker knows, but the broker in real life, I can look him in the face and say, we've got a relationship. Hey, I want to give you the best possible price, but I need to know what else is coming, right? And that was very common back in the day.
I see.
Yeah, Mark, any thoughts on that one?
Yep, totally agreed on the open outcry aspect. And like, maybe the broker doesn't necessarily know, maybe he's lying to you. Like, all those shenanigans happen, of course, that like, oh, I didn't know my guy had more or whatever. How many times have you heard that? But at the end of the day, that like repeated game, that trust element, like there is something to that actually in the end, like creates better execution prices for everyone, right? Market makers can provide like stable price discovery quotes, and customers can get better prices because you keep running a guy over. He's not going to give you a good fill the next time.
100%. Yeah. And don't forget, the other thing that happens, and this is good for the folks watching today, is that if you're picking on one strike on the downside part of the curve, and let's call it a put, you're buying 1,010 lots or 110 lots. If you pick on a certain strike, it affects everything around it, because butterflies have to stay in line. So do boxes. So do time spreads. All that stuff has to stay in line. So what happens is that if you're picking on one option, it's got to lift the stuff around it, which has a rippling effect on the curve, right? So all of a sudden, if I buy that one strike, it doesn't stay out of line. Everything moves. So the whole curve shifts in that equation, because all those relationships have to exist together. Otherwise, there could be an arbitrage, which will not happen, for a retail person to lock up. It won't happen. The machines move too fast, and it really shifts things quickly. Maybe not so quickly, depending on how. Look at nowadays, these firms have billions and billions of dollars. So maybe we should have said 1,010 lots versus 110 lots. I don't know, but there is a number, right? So,
it completely depends on the product. Yeah.
Yeah, for sure.
Yeah. So that also means
I think we're also like.
Go ahead, Mark.
Yeah, Mark is on delay.
I was going to say that, like, if we're talking about like moving prices and like moving volatility, like that's where kind of the human element of trading comes in, and that it isn't just a machine that, like, you know, you can say, like, we can look back at the tape and say, like, what price traded, how many size traded, but like how that traded or why that traded.
Now he froze.
He froze.
Maybe it'll reset and he
You
won't
know,
be on the
I bet you he's in New York.
I don't know. Well, I know he's not driving. I was looking at his at the back window there to see if that building was moving. And as long as he's not driving, then I don't feel so.
So I did a TikTok video, you know, several months ago, and I did it while driving in my car, and I was talking about risk management while I was driving. I mean, just pure dumb comedy, not even trying to be funny or cute, but it got a lot of views, and everyone's like as snarky as you can imagine.
Yeah.
And what
you got trolled
you are for driving and talking about risk management. I said, wait, I'm in a Tesla. It's driving itself. I'm faking it.
So anyway, going back to the subject at hand, I think the from my perspective as the customer, I do find, like, you know, I do get those 10 lots, you know, at a better execution price
than
1,000 lot. And I've never done a 110 lots, but maybe, like, you know, toward the tail end of those 10 lots, maybe the implied volatility shoots up because you still don't know. I don't know. There's got to be probably a magic number, right? Like,
so there is, and here's how it's determined, right?
Mm-hmm.
So your points are accurate, they're valid, and my answer to you is it depends. Here's why it depends, okay? And this is what happened with GameStop. Market makers need to be around. They create liquidity, okay, which is, we know that. Mm-hmm. However, internally, they need to be around liquidity. So the more that transacts, the better it is that they can lay things off. So my answer to you, or my what I pose to you, is that you are not wrong, but it depends on the product. So if you say that it's going to, 110 lots is going to move the SPX curve, I'm going to tell you to go freaking jump in a lake. No chance. It's a $1 trillion market. It takes a lot to move that. Yeah. If you say it's in John Doe tractors and they trade 10 contracts a week, you know, that is going to move the curve, those 110 lots a lot. I can absorb 1,000 lot in John Doe tractors, because what I'm going to do is say, here's your price. I'm already going to have lined up my hedge in the underline and, you know, done all my work and get it all hedged off. And I'm going to say, let's put this up here. Right. And now it's done. But if I'm in a trading environment where they're rapid firing at me, right, and it's not liquid at all, and I'm getting barraged in an illiquid stock, it's going to be a GameStop, and I'm going to raise price. You're going to have a Vana effect as well. I'm going to go chase the stock. Everyone's going to start doing the same thing, right? So that's what tends to go down. And the reason I say it depends is SPX, you're probably right. Probably not much of an issue. Or QQQ or spiders, you know, probably not much of a curve shift. It's just too big of a product and too liquid. So
I see.
And you're probably off. You know, I'd say that if you had to buy 1,000 lot, Jason, in the fund or whatever you're doing, in, you know, what, I don't even know in the liquid stock off the top of my head, but in the liquid option side, but whatever it is, if you strategically did 10 lots throughout the day, you might be able to disguise it.
Mm-hmm.
Right? And you know, if you leg into it that way, I'd say, okay, that's fine. You know, that probably can work depending. If it's your rapid fire 10 lots, they're not stopping, and then everyone jumps on and they're not, I mean, you're going to get skewed to death.
Yeah. I mean, I can't afford 1,000 lot of SPX or anything, but, you know, it's just, but, you know, arithmetically in my mind, I think, what's the difference? But I think maybe I see what you're saying, and it makes a lot of sense.
Yeah, it's a fine-tuned point. And, you know, it's good for the folks watching who trades. I'm guessing that most of the viewers don't trade 110 lots and make 1,000 lot. Probably, you know, there's probably a few people, but most of them don't. But so it's not, you know, at all super pertinent to any one particular trader. But it's nice to know. I always tell people, if you know what the other side of the world and marketplace is doing and how they behave, it's certainly helpful in your decision making, right? And that's why you have Voland, right? It's a great product, and it's super helpful in giving some insight into and how the liquidity community has to behave. We already know what they do, okay, by virtue. We know what liquidity providers typically do. They are edge machines. So they are constantly trying to trade bid to offer and hedge, bid to offer hedge, right? And when they can do that in small doses without any one particular gigantic hammer or continued pounding on the wall, then, you know, they just want two-sided paper all day long. I'll tell you, it's a dream come true if they can get that, right?
Yeah. Mm-hmm.
And look, you know, we say that it's a dream come true. In reality, if someone asked me, was that always true for you, Lex, as a DPM? Absolutely not. Absolutely not. The only time it was like that would be in markets that have movement, okay, that aren't, the movement isn't one-sided, meaning we're not just in this tariff thing where everything's down all the time. We're in a movement where, you know, nice big down days, then big up days, then big down. You know, people are going to speculate on buying calls, selling puts, doing all kinds of things, selling put calls, buying put. It's going to be all over. That's what we need. We need two-sided stuff, and then we can hedge our books up really well, option to option, and create even more edge.
Yeah, there was a lot of what was it? I guess like April 6th or April 7th. I'm sorry. That was a Monday.
Okay.
Where like the Trump tariff thing tanked the market, right? And there were a lot of iron condors getting sold 1 month out. Like the May 2nd, for some reason, there was like 14,000 iron condors that were 1,000 points. Like, you know, the canopy was 1,000 points.
Wow.
Like,
that's nuts.
So I mean, there was a lot of that coming in, and I'm thinking that's gotta help the market makers quite a bit. If they're, you know, there's panic puts getting bought all the time, something short gamma is probably helping them.
Well, look, and if what happened to us too, and again, a little different being just a straight market maker versus being a DPM, right? A DPM, you can't walk away. You got to be there. So there were times when we'd get the barrage of, you know, 110 lots or sometimes with 1,000. You know, it wasn't always 10. It was like, you know, a lot. And your curve has been shifted, right? Your implied volatility has gone up across the board. I'm, you know, assuming that they're all buy orders. And now I'm at a point where I'm like, okay, what the hell? I got to reach for things to kind of take in some risk, because all I've done is sell gamma, right? And it doesn't matter where I sell it. I can sell calls or puts are the same to me because I'm hedging them with stock. So I'm short gamma out the UU. And now when anything comes in on an offer, I reach for it. I end up reaching for it. Now that, you know, I just have to do that by nature of taking some of the cheese off the table. So that's what happens. I go reach for those orders just to get back into some sort of semblance of sanity with the position, right?
Yeah. So I got two questions based on what we spoke about. The first is, and I kind of know the answer, but you said DPM several times. What is that?
DPM.
Yep. What does that stand for?
Designated primary market maker. So it was a SIBO concoction way back when, and we had to market ourselves as an entity to get appointed in various DPMs, and we did very well on SIBO. We were one of the biggest beneficiaries of that DPM system. So we became specialists in N number of pits that had N number of stocks in them, and we got as to take all the risk and never leave. We got 40% of the order flow. Now that's changed. And I don't think it's 40% anymore. And there's not always a DPM. There can be LMMs, which is a lead market maker, similar, but there can be several lead market makers in an entity. I think SPX doesn't have any of this. VIX used to have it, but I think they eliminated it. So some of the bigger products don't have it. But you know, where a DPM's good and an LMM's good is in a newly listed equity option class that doesn't have a lot of liquidity. So, you know, market makers aren't going to go out there and make tight markets, but DPMs have incentive to by their nature of 40%. Does that make sense?
Oh yeah, no, I know. I just
Okay.
I knew that question would be coming in my thing,
Yeah,
and I figured
that's
you
the
had one
answer.
answer. Second question: You're
Mhm.
talking about your buddy who's a wine drinker who's very happy and his pockets are lined.
Yes.
At whose expense is that?
No, well, look at it's everyone says that maybe options trading is a zero sum. I don't know. It could be. So let's break that down real quick. If a retail person buys a put from a market maker and the market maker sells that put, if the stock goes down, the retail person makes money.
Mm-hmm.
And then you say, well, that means that the professional DPM guy lost money, right? Depends. Yes, he lost money on the put in this example, but don't forget what the DPM guy does. He's already sold his stock against that put. He's hedged it. So he's lost on the put and he's made on the stock. Now you say, okay, well, what about the stock? Someone had to buy the stock from him that he sold. That guy lost money. Maybe he could have hedged it with something else, So it rolls on down. Maybe ultimately it's zero sum somewhere. But for the market maker, I always said to people about GME, I always use GameStop as the most illustrative part of market maker behavior, right? It was insane. Mm-hmm. Initially, the market makers lost money on that whole phenomenon. Mm-hmm. But when implied volatility finally got to 500 or whatever it did, and I think Citadel was involved. I'm sure Susquehanna was. They utterly crushed it. Yeah. They killed it. They probably lost a little bit on the big run up. They sold all this stuff down here. They hedged it. It went up here. They got the off the distance. They kept selling. They managed their inventory. It finally settled in. It came back down. Implied volatility went from 500 to back to 80. They freaking killed it. Don't feel sorry for the market maker ever. Okay. They will figure out how to get out of it and wiggle out of hedges and difficult situations. That's their job.
Yeah, no, I don't feel bad for the market maker. I'm just saying that if there's somebody smiling, the impression is that if you trade options, you're happy with volatility. And I think the DPMs or the market makers or whoever, they're happy with the volatility because they're the ones that are benefiting from that spread in price, that illiquidity.
Absolutely. Right.
But just because, you trade in options, or even a retail person trading in options, that's actually the opposite unless they're perfectly strategically selling premium, right?
Yeah. So and don't forget the edge proposition for a market maker versus a retail person. What is the edge proposition for a retail person? I'm not sure. Right now, if you're really good at reading charts and you're always right, that's a great edge proposition, right? If you're very good at picking support and resistance levels and you put on intelligent option strategies around those and you're good at that, terrific. But you as a retail person, I always liken it to, if you need to buy eggs, you pay what the grocer's egg price is. That's all. You're not going to go negotiate it. You're going to go to the marketplace and buy your eggs. If you need to get into a spread as a retail person, you have one place to go, the markets. Yeah. And there's going to be a price, and you're either going to pay it or you're not, or sell it or you're not. That's it. You're like,
I remember in the heat of COVID, we needed a car, like we needed our minivan, like a family car.
Yep.
And at the time there was those supply chain problems and stuff like that. And there was only one minivan on the lot that we were at. And, or I guess it was like 2 or 3 or something like that. And they were trying to charge us more than MSRP.
Yep.
To which I said, no, I'm going to go, but you couldn't negotiate it because, they projected that there would be a ton of people out there paying for this minivan. And I think that's true with options. It's just, market maker knows that there's going to be a ton of people out there. Sure. Those volumes keep going up. But anyway.
Well, I just saw Henry on LinkedIn this morning, and the average daily volume this year, 2025,
like 60,
almost 60 million, 59.7 million contracts per day. Last year, 2024, it was 45, let's call it, give or take a million, 45 million a day. Now it's almost 60, 15 million more contracts per day. That's insane.
It is.
It's insane. Now, one of the other things, too, that's interesting is that I talked to that same wine-loving market maker buddy of mine, and he's seeing the same thing I'm seeing, which is even though volume is terrific in options, the retail side of volume is not as plentiful as it was. So their touch rate at retail is very much lower in the market maker community of late with this volatility. To me, that makes sense. In the retail world, this is difficult to trade these kind of markets because if you're a iron condor seller and SPOOs are moving 100 handles a day, you are getting your butt handed to you a lot and you're getting breached. So what do you do? Sometimes I always say the best trade is the trade you don't make. Sit on those hands, let things settle in if that's the kind of trader you are. Now, if you're the opposite kind of trader, okay, you're loving this. But retail people, I think, tend to struggle in this environment because of these gigantic moves, right? Are you seeing similar?
Oh yeah. I mean, it's sitting on your hands has been helpful in our trading anyway. I think I'm in like 97% cash during this time.
Yeah. So, and I get it. And, we on the retail side, over at Tradier, we're like, well, what the heck? What's going on? I tell them, listen, this is a tough environment for folks. They're going to watch and let it settle before they get back in this game. Right. Yeah. So it's not easy. Okay, cool. We probably have to run. Always good to see you. Sorry, Mark couldn't finish up because this was his topic. I put my email in the chat. That's crazy. There's a lot of people watching. Lex@Tradier.com. The reason I put it there is Tradier Brokerage is offering a special sort of promo, and it's a 3-month promo. It's about putting money in your account if you open an account with certain amounts, so on and so forth. But send me an email if you're interested. Just tell me your name when you send it, and then say, give me the details, Lex. You crazy, you know what? And I will give you the details. Okay.
Crazy cowboy.
Crazy cowboy. A derivative desperado risk wrangler. But it's a good deal. It's only 3 months. Lots of great plans. Jason, give us and the folks your website.
www.vol.land for the dashboard.
Yep.
And addamfunds.com if you are interested in an RAA.
Okay, and the addam, no one's gonna know how to spell that. ADDEUM.com, right?
Yep, FUNDS.com.
Oh no, I forgot that. Okay, don't strike that. That's not right. I'm putting funds or fund?
Funds, multiple.
Plural. Look it in the chat. Can you see the chat? See if I got it right. The second one.
Oh,
yeah,
that's it.
Let's go. Flexi. All right. Awesome, man. And Mark is Harvested Financial, doing similar things. And I know he's got some automation that he's working on with Peakbot folks.
Yep.
Okay, good. Aaron liked that. I think it was Aaron's. Here, let me put Aaron's little comment up here real quick before we leave. But yeah, unfortunately, Mark got disconnected. He sends his regards. But yeah, thank you for that, Aaron. We appreciate it. If you have,
we assume he sends regards.
Yeah, right. And always, everyone who's watching, don't feel shy. Now you know my email, Lex@Tradier. If you want us to talk about something and get some more insight into a topic, please send it. And guess what? If we don't know it, we're going to fake it. No, just kidding. We'll do some research and get back, and we'll do a show on it. The likelihood is we're going to get it, and we're going to knock it out. So we love to answer
all the time, and they don't.
Yeah, listen, there's a lot of things. I don't know much about the bond market. I know a little, but not like the pros like Jimmy and Bobby do. So we'll get Jimmy and Bobby on if we have to talk about bonds and commodities. So yeah,
sounds good.
All right, brother. You have a great weekend. Happy Easter. I know
you too.
That's damn. You must be into Easter, right?
Yeah.
Good man.
We're into Easter, definitely.
All right. Well, happy Easter. Have a great weekend, Jason.
You too. Take care.
All right. That's a wrap. Thank you. Happy trip.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.